Welcome back to another episode of Investing Explained. Here's today's question.
I think first of all, I look at a sell order as a point where I'm going to have liquidity, and then I have to have some other opportunity that's going to outperform what I think the previous holding is going to do. So if, let's just say, I own something, I have a massive gain, and if I sell it, I'm going to have a massive capital gains associated with it. And so let's just say that that was a long-term holding. So whatever principal I get from the sale, I now have 15% less of that that's lost due to capital gains tax. When I employ that new capital, what kind of return am I expecting to get out of that? And then when's it going to basically exceed the previous holding or the previous valuation that I had for the other business as far as return goes? So that's kind of like the mathematics behind my thinking whenever I do exercise a sell order. Another time that I'll sell that doesn't follow that model is if I think that there's just something fundamentally wrong with the business, and I think that there is some type of issues, and I just want to liquidate the position. So that's typically because there's impairment on their balance sheet for one of their major assets that I think there's some competitor that's come in and is going to basically take all the market share, and it's going to cause a lot of punishment for the pick. So those are kind of the two main ways that I look at it. Now, how do I manage some of that risk? If you asked me 10 years ago, I would tell you that what I just described was exclusively how I look at selling positions. Today, I would tell you that I also incorporate the momentum status of our, we have a momentum tool on our TIP Finance. One of the nice things about this momentum tool is it looks at statistical volatility ranges of a pick, any pick, and it's tailored towards that pick. So like, let's say the S&P 500, it's going up, it's going within a certain volatility range. And then whenever it steps outside of that volatility range, the momentum tool says something's different. This is most likely going lower because it's outside of this trading volatility range. And then it turns it into a red status. So the way that the tool's working is it's basically selecting a stop limit for that underlying pick. And that stop limit is dynamic. And so as the price goes higher and higher, the stop limit keeps adjusting higher and higher. And so I use that tool, especially for indexes. I use that tool because it's really hard to come up with an intrinsic value for the S&P 500 outside of just looking at the price to earnings. And so my opinion is that if the price goes through that volatility range and hits that stop limit on an index, it's more macro related than it is earnings related or functioning of the business. So I use that to also assist me in knowing when to stop holding a winner. And so, for example, like the S&P 500 on our TIP momentum tool, the thing has been green for a very long period of time, and it recently went red, and then it just went back into a green status. So there's a tax realization to that, but there's also the implication that I'm protecting my downside risk, because if the market would crash 40% in a day, which you had in 1987 or some other events that were very deep, you're protecting yourself from those types of events. So I would add that in there as well as a way that I also protect my downside risk and that I continue to hold winners that just keep on running.
I really like the question too. And actually, I would like to put into the mix a few fun facts about Buffett before I go into my own strategy, which is very similar to what you also described there before, Preston. But I think Buffett is one of the best examples of not selling your winners. The vast majority of Buffett's portfolio, it's concentrated in just a few companies, including American Express, Apple, Bank of America, and Coca-Cola, which is a very famous example of a position that's worked out really, really well. And all the investments that I just mentioned before, they have been very profitable. And aside from the Apple acquisition that was initiated back in 2016, it's all stocks that he has held for a very long time. Now, I really agree with that sentiment because in the sense that I really sell my winners too. Generally jump in and out of winners hard, and if you find really good stocks that are compounders, you don't want to jump in and out of it too often. Part of it is tax. As Preston mentioned before, if you live in the US, that's 50%. So in that sense, you just have to be more right than wrong. So really to sell your winners, it has to trade a lot higher than intrinsic value. So say a company like Berkshire Hathaway, trading 172 today. Like if that was going to 300 tomorrow, like yeah, clearly I would take the tax loss. I would take the tax on that and sell my position. But the more capital gain that you have earned, the harder it simply becomes. Coca-Cola being an example, like I mentioned before, Buffett built that position for $1.3 billion. And I think the last time I looked it up, it was trading around $18 billion. So it's a lot of tax he has to pay. Even though the Coca-Cola at times have been quite expensive, it just doesn't make any sense.
Stig, I just have something I want to add onto what you were saying there real fast. So with the example that you provided with Berkshire Hathaway's price, let's just say it doubled. In the past, 10 years ago, I would have said, yep, let's sell it. Let's move it into the other undervalued picks that I have. And then if the price comes back down to where I think the valuation is, then I'll start reaccumulating it. Today, I would tell you if the price doubled, I would continue to hold it until I would see the price volatility go below the stop limit. Just because maybe the market is going to continue to, you saw this with Tesla where the price just went crazy. It went up to like $600 and I'm like, this is maddening, right? Like this price is nuts. And then it ran to 1,000. So if you're using a momentum indicator for your point where you're going to exit the position that just keeps running, you would have continued to hold Tesla. It would have gone up to 1,000. And then when it started to drop back down, call it at 800 or 700 or whatever it was, your stop limit hits. That's when I would sell. Is I allow it to keep running because I have no idea how much fear of missing out the market's going to price into that run. But then I rely on that volatility range to help me know when it's time to pull out of that and then go into the other undervalued picks that I'm finding on the market.
It's really unfortunate that you talked about Tesla because it really had like an interesting segment about the inefficiency of the stock market. And whenever we now have primed everyone to thinking about Tesla, I don't know if I can really bring my point back home with that. But I guess my point is that the market is relatively efficient, at least over time, it has proven to be. And so whenever I'm saying that and using that as my premise, and please forget everything about Tesla that Preston just mentioned whenever I'm doing this segment here. But sometimes whenever you do invest in a stock and it goes south, like really, really south, that momentum can really save you because guess what? You can be wrong. Like you can be wrong. And sometimes whenever it drops 50 or 60%, that's not because the market is terribly inefficient. That's just because you're wrong. Your analysis, your facts were just wrong. And that's why I think it's so valuable, looking away from tax here, that you have some sort of tool that can go in and say, hey, you might be right, the whole world might be wrong, but you might want to take 2 seconds and reconsider. Perhaps you are wrong, and perhaps that's the time when you need to get out of that stock.
This is a really simple math exercise that I think many investors don't understand. If the price goes down 50%, now you need 100% gain in order to get back to neutral, to where you were. And the way markets work is it's almost like if you went and you had to destroy a building. You can push a button and the whole thing just falls apart really fast. But if you're going to reconstruct it and build it back up, like you see these stadiums that they explode, that they get rid of, it happens in an instant. You can destroy things in an instant. But then to rebuild it, it takes forever. And so that's one of the other reasons why I really like the stop limits on momentum, is because it takes a lot of the emotional piece out of it that you naturally have when you buy a company. And it's just saying, hey, statistically, there is something that's different, right? At this point in time, there's something that's different. So you can either keep following your emotions, or you can just look at it from a mathematical standpoint and protect your downside, so that you're not having to rebuild in the event that you're wrong. And that rebuilding might take 5 years in order to get back to neutral, right? Or you can take a systematic loss and move out on your next pick and protect your downside risk. So when Buffett has his rules of rule 1, don't lose money, and rule 2, refer back to rule number 1, I think the essence of that statement is this idea that when you have a 50% downturn, it takes 100 to get it back. Or if you have a 30% downturn, it takes X to get it back, which is way higher than 30%. So that's important for new investors. I think many new investors don't understand the implications of that, especially if you've never lived through a significant downturn.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.